good day. So we are continuing our lesson today on the methods of calculating or estimating depreciation expense. So previously we had done the straight line method. Today we are going to do what is called the reducing balance method. This is the other method used in CSEC to calculate or estimate the annual depreciation for the income statement. So as you would see, the formula for the reducing balance method would be the depreciation rate by the net book value. So remember, we had gone through certain terms. So we had the cost, which was the historical cost or the purchase price of the non-current assets. For example, your motor vehicle. It is what you would have purchased that non-current asset for. The net book value was calculated as the value after the depreciation of the non-current asset. So it is the value after the non-current asset has been used for a certain amount of years, for example. How much has it reduced in value because of that use? So that was the net book value at the end of a particular period, which you calculated as cost minus the accumulated or total depreciation. So basically, the reducing balance method does not use the cost as the figure for the percentage multiplied by cost. It is the net book value, which means that we will have to deduct or subtract the accumulated depreciation to get the net book value, and then we will use the depreciation rate to calculate the annual depreciation. So as you see there, depreciation rate percentage multiply, and this is the long formula which takes into account how do we find the net book value? Cost minus accumulated depreciation. I think I repeated that over. See, repeated over. That's to tell you how much I repeated. So hopefully that is the main emphasis here. If you see straight line method, percentage by cost. But if you see the reducing balance method, it will not be percentage by cost, but percentage by net book value, which you calculate by subtracting the accumulated depreciation from the historical cost. So here we will have an example. Annual depreciation is equal to percentage multiplied by net book value. So percentage multiplied by cost minus accumulated depreciation, because this is how you find your net book value. So for example, you have a motor vehicle that cost $20,000. Accumulated depreciation is $9,400. Depreciation rate is 20%. So how will we find out, or how would we calculate the annual depreciation using that reducing balance method? So annual depreciation is equal to, as we said before, percentage by net book value. So therefore, it will be 20% multiplied by the net book value, which is $20,000, the cost, minus the accumulated depreciation of $9,400. So that will be 20% multiplied by $10,600, which will give you $2,120 for the year. Remember, we are calculating annual depreciation, so yearly depreciation, the depreciation expense at the end of the particular period. And this is how you would do it using the reducing balance method, percentage by net book value. So here's an example. We go into the example one time, and we will have your fixed assets, motor vehicles again. And the cost of that motor vehicle is $40,000. It was purchased on the 1st of January 2011. So these are our years, 1, 2, 3, 4, 5. So we are using the remote vehicle for 5 years. And then the depreciation rate is 20%. But the method that we are using is the reducing balance method. So it is not going to be a simple case like the straight line method of just percentage by cost. Because remember, the formula, when it is that you're using the reducing balance method, the formula percentage by net book value. And unlike cost, net book value changes every single year. For that non-current asset, it changes. So therefore, you will have to do a working for each particular year. Unlike straight line, you just worked it out and that was the amount for all of your years. This one, we're going to do it for each year. So the first thing that you do every time that you have to work out something, your formula. Well, let's get out of the way. We're getting out of the way that the cost is $40,000. So we got that out of the way now. And we are going to calculate your annual depreciation. So your annual depreciation percentage by net book value, since we have to do it for each year, that is what we are going to do. So your net book value for your first year of operating is your cost, because you did not use that, or it was not depreciated until this year. So there is no accumulated depreciation before this year. So 2011, there was no accumulated depreciation. So therefore, accumulated depreciation was 0. Think about it. You now depreciated the asset. So which means that your net book value before would be the same as the cost, which is $40,000. So your first year, it will be 20% multiplied by $40,000. And now we know how much it depreciated by for the year. So you get it? For us to be able to calculate how much it was depreciated for the year, we have to find the net book value. The net book value before would have been the same as the cost because you had not depreciated as yet. So the only figure that you have is the 40,000 to be able to calculate your depreciation. So it's 20% of 40,000, 8,000. And now we have how much it depreciated by 8,000. That comes first. And then now we can calculate our new accumulated depreciation. So now that we have calculated how much it depreciated by, your accumulated will be the $8,000. And now we are going to have a new net book value at the end of that 2011, where we see it is 40,000 minus your 8,000, which gives you $32,000. So don't get too upset if it is that you're like, what is the net book value? I don't know. It's not supposed to be cost, but for your first year, the net book value and the cost of the non-current asset are the same. And then you use that cost figure, which is your net book value at that point, to calculate your annual depreciation. And then you get a new accumulated depreciation because you have now reduced the value or depreciated that non-current asset. So your new value at the end of 2011, your net book value is now $32,000. For the next year, 2012, it is the same formula, percentage by net book value. So basically it will be 20%. And now we have a new net book value. So before we calculate how much it depreciated by or the annual depreciation for 2012, to do so, we have to use the previous net book value, which would be the 32,000. So you're working for 2012 is going to be 20% of the 32,000, which will give you your annual depreciation for 2012 as 6,400. So you have 6,400. You can now go through the steps. You calculate your accumulated. Your total depreciation is now the 8,000 plus the 6,400. So you will now have 14,400, which you subtract from your cost to get your new net book value, which will be 25,600. And once you just maintain those steps, so you're going to 2013, 20% by 25,600, you get a annual depreciation of 5,120. So that goes in this column here. And now you have the next step, accumulated. How much is your total depreciation? The 14,400, add the 5,120, or you just add up these three figures, and your total is now 19,520. So therefore, to get your net book value, which is the next step, cost minus accumulated depreciation, cost minus accumulated depreciation, cost minus accumulated depreciation, and that will give you your new net book value of 20,480. And then we have for 2014, you do your working again, always percentage by net book value, and it will be the net book value previously to now calculate the current or the present annual depreciation. So it will be 20% by the 20,480. That is your new net, your previous net book value, and you get 4,096, and you will put it here. This is the time where I am going to point out, we do not use cents, not cents, cents, right? So as in money. We don't really use that in accounting. It's to make it simpler for now, right? For CSAC and exams and stuff, we round off to the nearest dollar. All right, so if it is that you had gotten, I think it was 4,096.22 or something like that, you will just put it as 4,096. If you got 4,096.7, it will be 4,097. So what you learned in math, you would just apply here in terms of the rounding off to the nearest dollar. Okay, so you have your annual depreciation 2014 calculated as 4,096. Next step, what is your accumulated? It will be all of these. So you add up all of these, or the sum of all of these, or the 19,520, which was your previous accumulated, add your new accumulated, or your not new accumulated, your annual depreciation. So let's start again. It will be your previous accumulated depreciation, add your annual depreciation, your current depreciation for this particular year, and you will get a new total or accumulated depreciation of 23,616. What this says is that your motor vehicle, after having been used for 4 years, 2011 to 2014, it has depreciated by $23,616. And because of that, the new net book value, or the value after it has been used and depreciated for 2014, your net book value is going to be 16,384, the cost minus the accumulated depreciation. And then finally, we have 2015, same calculation, percentage by net book value, and it will be the previous net book value, which is 16,384. So 20% by 16,384. And what you will get is 3,277 as your annual depreciation. Then you just work out your accumulated, which will be your total, or your previous accumulated, add your current annual depreciation, which will give you your new accumulated as 26,893. And therefore your net book value would be 40,000 minus the 26,893, 13,107. So that is it. Basically, if the exam were to give you a table to do in terms of these different years, you just have to do a format. And unlike the straight line method where there is just one working for it in terms of the amount of years, because it is the same annual depreciation throughout the useful life of that particular non-current asset. Unlike that, with the reducing balance method, you have to do a calculation for each year, because the formula, how you calculate it, percentage by net book value. And as you can see, net book value is the value after it has been depreciated. So which means it will change from year to year. And the net book value that they're talking about, of course, will be the previous net book value, because you're now going to calculate the annual depreciation. So once again, we are not speedsters that could go to the future, find out how much you depreciated by, work out the net book value there, and then say you're going to use that for the calculation. No, that makes no sense, right? So you're going to use the past net book value to calculate the current annual depreciation. Okay, so once you just keep it steps, remember the formula and do your working. So here's something that I would like to point out again. So remember with the straight line method, as we kept on saying, the annual depreciation was the same straight line, straight across the board. That's how you look at it, you know, the same figure. So if it was 8,000 at the beginning, 8,000 throughout, straightforward. Cool? Reducing balance method refers to the annual depreciation, not the net book value, because both net book values reduced. So that is not what they're talking about. For straight line and for reducing balance method, it does not matter in terms of the net book value. Net book value is the value after it has depreciated, which means the value is going to go down whatever method you use. What they are referring to in the name is the annual depreciation or the actual depreciation. So for straight line, straightforward, same amount. But let's see that for the reducing balance method, which is referring to the annual depreciation, what you would see is that annual depreciation starts off at 8,000. It drops to 6,400. It reduces again to 5,120, reduces again to 4,096, reduces to 3,277. So remember with the little explanation, we said, you know, in reality, you get more out of a non-current asset at the beginning of its use. When it is new, when you have just purchased it, so you will get $8,000 worth of usage. Basically, that's what the depreciation is. So the value from your not 20,000, from your 40,000 value, first year you got $8,000 worth of use. That is why the depreciation was incurred, and that is why it reduced its value. Then the 2012, you did not get the 8,000, you got less because it is being used, it is depreciating in value, which means that in reality, it can be stated that that means you're going to get less out of it. And then for 2013, as you continue to use it until eventually 2015, the amount of use or the benefits you're getting from it is not as much as it was previously. Okay, so these are basically the methods. So that would be the two methods in terms of calculating depreciation. So once again, straight line method, reducing balance method. Reducing balance method just takes a little bit more time in terms of calculating for different years. When we go to do the income statement and the balance sheet, you are just doing for one particular year. So it will just be one calculation for that. What would differ is how you calculate the depreciation. They will tell you whether to use the straight line method for the particular non-current asset or whether to use the reducing balance method for that particular non-current asset. And you just have to follow the instructions. If they tell you straight line method, they give you a percentage by cost. If they do not give you a percentage, straight line method, cost minus disposal value over useful life of the non-current assets. These are estimates, of course, except for cost, which is a definite figure. And then if they tell you it is reducing balance method, you will use the formula percentage by net book value, or the long version of that will be percentage by cost minus accumulated depreciation. Or you just work out your net book value. You say net book value is equal to cost minus accumulated depreciation, work it out, and then find the percentage of that net book value. All right, so we will be doing that in our next lesson, even though in terms of the accounting cycle, basically you would take these figures and you would put them into your T account, and then you will put them into the income statement. But because of the flow of things where, you know, as I said before, you see here that these are the figures that go into your depreciation sum, into your income statement. So your annual depreciation goes into your income statement. And this is the three things, or these are the three things that go into your balance sheet, just like this. We thought that it will be good to just take this table and now just show you how it goes into the financial statements or final accounts. And then we will go back and we will do the T accounts. Okay, so till next lesson, please just do the activities as a practice and you will realize that it gets easier with time. All right, next lesson.